This is Josh Ignosky with American Wholesale Mortgage, and I am doing a market update with the Sean Buchan Realty Group, and I'm super excited to be here and a part of this organization. And here is where the market is right now. There is a huge misunderstanding between a Federal Reserve interest rate and a mortgage rate, and I want to clear that air first. With Federal Reserve, that is the institution that lends money to our banking system. Mortgages are not a banking product. Mortgages are tied very closely to our treasury bonds. It has nothing to do with the Federal Reserve rate. Why did their interest rates go up the day that the Federal Reserve went down? The answer to that is they're not related. Federal Reserve drops their percentage point by 0.25%. But the mortgage market had already priced that in advance, knowing that the Federal Reserve would probably be dropping their rates. When we say interest rates are not going to go down, even though the Federal Reserve rate is going to go down, and the customer kickback is, hey, we think rates are going to drop, understand, we will honor your request not to lock in an interest rate, but we appreciate when you say, hey, whatever it is that you think, let's do that. I had every single one of my clients say to me, Josh, lock in the rate ahead of the Federal Reserve. The worst thing we possibly could do is have a higher rate. Now, what is the benefit of locking a rate when you go under contract? You avoid negative market movement. What's the risk there as well? Well, could interest rates move further south? Yes. What happens to that? What happens to my loan if my interest rate is higher than the interest rate available when we get cleared to close? Well, the good news is that interest rates are going to move both north and south throughout the entire life of your loan. Sometimes they're going to continuously stay above where you locked in, and sometimes they're going to drop below that. And in this case, we say to the client, if the interest rate drops after 6 months, then we'll just simply refinance the loan. Well, aren't there a lot of closing costs involved? There can be. Well, are there ever such thing as free loans? Sure there is. Interest rates are like seesaws, but so are closing costs. When the seesaw is exactly even, the interest rate and the closing costs, the interest rate is what's called par, and the closing costs are all the third-party fees associated with that. But if I wanted my closing costs to drop, then my interest rate's going to go up. I'm going to take a higher than par rate. And if I want a lower than par rate, then my closing costs are going to go up because the opposite side of the seesaw. Those are those people who are buying the points down. Now, Josh, I want a really low payment, and I thought that it had to do with the rate. Well, you're kind of right. There are options in which clients can use seller concessions, so money from the seller to you, to lower the payment without lowering the rate. How is that possible? Well, you can do what's called a temporary buy down. A temporary buy down is going to have the greatest impact on the monthly payment, but also for the shortest period of time. So an example would be if the par rate were 6.375 and you did a 2-1 buy down, you would actually make payments based off of a 4.375 for the first year, then a 5.375 for the second year, then a 6.375 for the remainder of the term. Oh, how does that help me as a client? Well, when you have rates that are volatile, an administration that's actively trying to put housing into a position to win, meaning housing becomes cheaper through lower interest rates, the goal is that you're locking in a rate now, you're locking in the cost for the home now, but your long-term payment is not going to be truly established until years 1, 2, or 3. And in this case, this temporary buy down allows for you, the buyer, to buy the home at a lower price point than it would be in the future with lower rates. So those lower rates are going to create a greater demand for housing. Right now, we don't have a great demand for housing because interest rates are creating a barrier to entry. What happens with supply and demand? It is simple economics. When there is more supply and then demand steps in, you have a situation in which people will then compete for that supply. That's going to drive prices up. That's going to create bidding wars. And now we have an inflationary situation, meaning the cost of the house today in the future is going to be higher for that same exact house because the demand and the supply will be met with lower interest rates. So when you buy the house lower today and refinance to a lower interest rate tomorrow, you win. the consumer wins. And in this case, I would recommend taking the temporary buy down. Well, Josh, what happens to the money inside of a temporary buy down if I refinanced it 6 months from now or a year from now? The answer is all that money that was given to you by the seller will be used to temporarily reduce the loan that you owe. Start that one again. The money that will be used by the seller that has been collected for you will be used to pay down your loan. So your principal balance of the loan will be reduced by the amount of the unused portion of the temporary buy down. So it is a win-win. But what about a permanent buy down, Josh? What about a permanent buy down? I don't want to deal with possibly the rate payment changing. I don't get that. The answer there is on a permanent buy down, the same amount of money may only reduce your payment by maybe $100, maybe a little bit more, versus potentially $300, $400, $500, $600 a month in a temporary one. A permanent buy down buys the rate down permanently over the entire life of the loan. Therefore, the reduction in the payment is going to be less because you're not able to buy as much of a change to your interest rate. Whereas a temporary buy down for that same money is going to be reducing considerably more of the rate because of the amount of time it's being reduced by. On a permanent buy down, if you refinance that loan, then unfortunately, everything you spent is lost. There is none of that money coming back to you. There is no value beyond it. So when you go to refinance and you invested $10,000 in closing costs, that $10,000 is gone. In a temporary buy down, only $1,000 out of the $10,000 used, $9,000 is going to reduce your balance on your loan. It is the better choice. It is the greater reduction in payment. And all of us make our payments based off of our income. None of us are going, man, I can't wait to stroke the check to pay my mortgage at 4%. We all say, man, my mortgage is $2,000. I need to write a check for $2,000. So utilize the seller concessions to increase your ability to own your house at a lower payment and decrease your chances of having to pay more for that house in the future simply by waiting for something that is not guaranteed.